Peter Lynch final speech of the course. If you don't understand, you can call the psychic hotline. The great investor Peter Lynch is going to explain the keys to investing this year. Let's get started. Hello and welcome. Peter Lynch has been one of the best investors in history, and there is much to learn from him. He managed the Fidelity Magellan fund from 1977 to 1990, with an average annual return of 29%, making it the most profitable fund in the world, where he turned every dollar into 28. I believe the market is currently fairly priced. You have to think that over the next 10 years, the stock market will have increased by around 7 to 8% on average per year. That means doubling, including dividends, approximately every 10 years, multiplying your capital by 4 every 20 years, and by 8 every 40 years. These are the kind of numbers that interest you today. In contrast, a 10-year bond is currently around 3%. So I believe that the stock market is the best place to be in the next 10, 20, or 30 years. I have no idea what the next 2 years will bring. I have never known what the next 2 years will bring. I guarantee you that the stock market will be higher in 15 years than it is now, and it will be much higher in 25 years. What the market will do next year or in the next 2 years, I have no idea. And if someone in this room knows, they won't tell anyone. Either they are not in this room and are in some paradise-like place, having made billions of dollars. Peter Lynch indicates that the long-term profitability of the stock market will be higher than that of bonds. Historically, this has been the case. Here we can see that the one-year return of the stock market has been highly variable in the last 72 years, with gains of up to 47% and losses of up to 39%. However, over a 5-year period the range is considerably reduced, with a maximum loss of only 3% per year and a maximum gain of 28% per year. And over a 20-year period, even in the worst-case scenario, money has been made. For this reason, Peter Lynch says he doesn't know what the stock market will do in the next 1 or 2 years, but he affirms that it will rise in the next 15 or 25 years. So, the longer the investment horizon, the greater the probability of gains. The long-term profitability of bonds will likely be lower than that of the stock market, but this doesn't mean that bonds cannot be a good investment for low-risk profiles or for those who want to have a portion of their portfolio in fixed income. It depends on each investor. On the positive side, public information is much more available today. When a company presents its results, the results and the presentation itself are openly accessible on the company's website for everyone. For example, information like Nike's inventory or anything similar. In the past, we had to wait to receive this information by mail on paper. Now, all this information is much clearer and accessible to everyone. Individual investors now know the same things I do. You never want to invest in companies with a bad balance sheet. You don't want to invest in companies that have $8 billion in debt, no cash, and are losing money. That's a terrible combination. You have all this information now. So the information is much better than it used to be a long time ago. An investment will be good or not depending on personal situation, age, heritage, income versus needs, people who you care for, personal goal, risk aversion, gut strength, available time, knowledge. This is the main change. Peter Lynch has always advocated for the ability of individual investors to achieve good returns in the stock market. One reason is the accessibility of information available to the public today. However, this doesn't mean that anyone should invest in the stock market. To invest in stocks, one must be mentally prepared. Lynch has indicated that trying to predict what the market will do is pointless because he doesn't know what the stock market will do in 1 or 2 years, let alone the next month or week. We have seen with data the variability of stock market returns over a 1-year period. Music. The key organ in the stock market is your stomach, not the brain. The environment will always be terrifying, and there will always be something to worry about. You simply have to forget about everything, cut it all out, and just own good companies. Study the changes in your portfolio, and you will do well. In 2020, the S&P 500 dropped by 35%, and it happened very quickly, within a month. Now, the decline is around 20%, but it has lasted for over a year. Although it is a smaller drop compared to 2020, the longer duration causes much more mental strain. The longer the duration of the decline, the harder it is to endure. You need to have the stomach for it, as Lynch says. In 2020, people were optimistic despite the market declines. However, in 2022, there has been a lot of negativity. Now, there is much less interest in videos about relationships. If 2022 and 2021 were years when many people started investing in the stock market, 2022 has been a year where some of these people have abandoned it. Part of the negativity may come from the fact that the Nasdaq has experienced a larger decline, and high-growth stocks that were popular in 2022 and 2021, as well as cryptocurrencies, have plummeted. It usually doesn't end well when people seek easy and quick money. Warren Buffett often says that people lack the patience to get rich slowly. Instead, they prefer to go broke quickly. It's easy to say, I'm in it for the long term, but when the first declines come, opinions change and people abandon the stock market. So, you need to have the stomach for it. I don't worry about stock market declines. I know that in the last 96 years, the market has experienced 53 declines of 10% or more. That's roughly a 10% or more decline every 2 years. Out of those 53 declines, 15 have been drops of more than 25%. So, on average, there's a 25% or more decline every 6 years. That's what we call a bear market. Stock market declines are something that will happen. I don't care when it will happen. I would love to know, obviously, as it would be very useful to know when it will happen. But what's important is that the stock market will probably be higher in 8 years, much higher in 16 years, and much, much higher in 30 years. That's what matters. Here we have the bear markets of the last 100 years, some longer, some shorter, some deeper, some less, sometimes more frequent, and other times many years pass without any. But what we need to know is that they will happen, and after a bear market, the biggest bull markets begin. In general, stock market declines are an opportunity. With this mindset, we would be mentally prepared to invest in the stock market. The key is when a stock goes from 10 to 6, for example. If you understand what the company does and know that it is financially sound, you'll be fine. But if you don't understand, you might call the psychic hotline. If you don't understand, you'll do what you shouldn't. But if you fully understand what you're doing, if the stock drops from 10 to 6, you will buy more shares. However, if you're confused at the beginning of the decline, you might say, there must be something wrong here, and as it continues to drop, you won't want anything to do with it and you'll sell. But you have to know and accept that stocks will often experience drops. To understand a company well, it must be within your circle of competence, and you must have studied it thoroughly. If a stock drops but the company is doing fine, it can be a great buying opportunity. However, the decline could be due to a significant deterioration in the company's fundamentals. In that case, you would need to reassess the company to decide what to do with it. 1. Good investment shares. Profitability shares greater than bond profitability. Lots of information available. The more years, the more probability will rise. 2. Are you mentally prepared to invest? Don't predict market. Have strong gut. Market fall equals opportunity. 3. How to invest? Understand very well what we buy. Let's look at some examples. Mode fell by 76% in less than a year. Part of it may have been due to the stock being overpriced, but another part was the general decline of growth stocks. It could be an opportunity, and that's why we mentioned it in June 2022. Medical properties also dropped nearly 50% in 2022, but it has a fairly stable business, which is why we mentioned it in the New Year's Eve video. Apple has experienced major declines throughout its history, and the market dropped sharply in March 2020, offering great opportunities. Even the greatest investors experience declines. This is what Peter Lynch said when people praised his Magellan fund. You're kind enough to say nice things about Magellan. But in those 13 years, it decreased more than 10%. A 10% drop occurred every little over a year. Unfortunately, that was the moment when many investors in his fund decided to sell. Perhaps if they had understood what they were buying, they wouldn't have done it. Understanding the companies you invest in will give you confidence in your purchases, and that will give you a stronger stomach. Peter Lynch summarizes it as follows: if you don't understand a company, if you can't explain it to a 10-year-old in 2 minutes or less, don't buy it. Because if you don't understand it when the stock drops, what will you do? Panic. Since World War II, the market has almost always traded between a PE ratio of 10 and 20. If you look at the Dow Jones or the S&P 500, if you add up all the companies and their earnings, you'll see that there is a relationship, and it holds. McDonald's profits have been fabulous in the last 30 years, and the stock's trajectory has also been fabulous. There is a direct relationship. The price-to-earnings ratio of the S&P 500 has been within that range of 10 and 20. When it reaches 20, the S&P 500 doesn't have much room to rise. When the PE ratio goes above 20, it's usually when inflation is close to zero, like in the early 1960s. When inflation was almost zero, we had a PE ratio of over 20. Normally, if you subtract 20 from the inflation rate, you get the worst PE ratio in the market. This has been a formula that usually works. When inflation was 12% in the early 1980s, we had a PE ratio of 8 or 9 in the market. The 5-year return of the S&P 500 is higher when the PE ratio is lower. Currently, it is at a moderate level. This is a much more reasonable level compared to the beginning of 2022 when we could say that the stock market was expensive. Other markets like Europe and Japan are trading at relatively cheap multiples, despite experiencing less significant declines in 2022 compared to the S&P 500 or Nasdaq. Before we continue, I would like to thank you once again for liking the videos. It greatly helps the channel. If you're not subscribed and enjoy the content, I invite you to subscribe and share the video with someone who shares your interest in investing. Like in any major bull market, there are sometimes subsequent declines. However, these declines are healthy. In fact, I would prefer the S&P 500 to drop by 500 points rather than going to 6,000. Look at Japan. The Nikkei went from 5,000 points to 15,000. At 15,000 points, the index was reasonably priced considering the company's earnings and other factors. Then it reached 40,000, leading to 7 years of inflated housing prices, excessive spending, and essentially a recession for 5 or 6 years. When the market rises too much, you are discounting earnings for 7 or 8 or 10 years. When you pay a very high multiple, you're paying for very high expectations that are likely difficult to meet. If they are not met, the market will start valuing the stock at more reasonable multiples, and the price will decline. The average PE ratio of the stock market is 15, and that's what companies tend to trade at when they are mature. Lower quality companies will trade below that, while higher quality ones will trade above it. But no company will trade at high multiples forever. Of all the stocks, this is a company that I really like. The fundamentals are great, its profits are doing well, and its competitors are doing worse. I think this company is performing excellently in its business. The stock is trading at 40, which would be a fair price. Suddenly the stock drops from 40 to 30 due to a market decline. And you would say, wow, it's a buying opportunity here. That's what you should look for, not a stock that went from being overpriced to fairly priced, but a stock that is undervalued. You'll be researching like crazy, looking for companies with a similar story to the one I just mentioned. Usually the lower the PE ratio for an index is, the higher the returns are. Source: Guide to Markets, J.P. Morgan. Peter Lynch wrote that markets should be closed more often so that we spend less time looking at stock quotes and more time analyzing stocks. We can learn a lot from Peter Lynch. Another person we can learn a lot from is Warren Buffett, who explained how we should invest in 2023 in the video I'll link here. I also invite you to subscribe if you enjoyed the video, hit the like button, and remember to buy low and sell high.